If you're still struggling to find high quality trades like this one on a consistent basis, then this video is for you. Because I want to share with you, over the last 5 years of trading, the 2 key concepts that I've used to go from lost, confused, and unprofitable to clear, confident, and most importantly, consistently profitable. In this video, I'm going to be sharing with you step by step both of these trades playing out using the 2 most important concepts that enable me to take trades like these on a consistent basis. So let's dive in with key concept number 1, which is institutional direction. Your goal as a trader is simple. You need to be able to identify smart money. You need to be able to understand in which direction is the money flowing into the market. If you can get that right, you've got most of it done. The way we do that is for reading market structure. You see, when large institutions move price, they leave their footprint. So it's easy to understand their initiative if you understand how to read it. So here you can see we're on the 15-minute time frame, which is my primary time frame that I do use for my analysis. If we zoom out, you can kind of see the scope of things and what's actually going on. So the first thing that I do when I get to my trading desk in the morning is try to understand, in this session today, what direction should I be trading? Should I be trading long or should I be trading short? So we'll take this first example down here, this London session short position. This is price just before London session begins to open. Now what I'll do is, for the sake of the clarity, I'll remove this for now. And what we need to do is we need to understand the direction of price. It's very, very simple. The problem is that most people have difficulty actually understanding which direction the market was in. I mean, if I was to look at a price like this and ask you the question, should you be looking for long positions or should you be looking for short positions right now? Some of you may say short. If then I pull out like this and ask you, well, now, should I be taking long positions or should I be taking short positions? Some of you same guys who just answered short may now be saying long. And the reason is because you don't have an actual repeatable process that tells you consistently how to actually understand whether we should trade long or short in this specific session. So the first thing we're going to do is we're going to identify how we actually map out our highs and lows. We can see here we have a clear low. Now what you want to be looking for when you're identifying your swing points, look at where price reverses. So when you see price doing this, just understand, simply put, where is price reversing from? We have a low down here, price aggressively moves up, and then we start pulling back. The reversal point is right here. Then price moves down, price begins moving back up. Well, the reversal point is now here. Price moves up, we have a break of structure. So it's confirmed that we're bullish. We have a high up in here that starts to give a pullback into this area, and then we start to get a continuation. Well, then it's easy to understand that these are our swing points, right? Where price reverses from, that gives us our direction. The issue is many people don't actually know whether a high is a high or a low is a low. Because if we look at this price leg in here, for example, you can quite clearly see we have highs, we have lows, we have highs, we have lower lows, highs, lows, highs, lows, right? So many people may be looking at this and thinking, well, it's bearish, but it's actually contained within a range because we actually have a low right here and a high right here. So all of this is internal structure. Many people make the mistake of trying to trade this internal structure. That isn't going to work out too well in the long term. What you want to do is you want to understand where price is actually breaking structure. So if we look again and we see that we have this low down here to this high up in here, and then this low down here and this high up in here, and then what happens? Price comes back down to this low, wicks it once, comes up to the high, gives us a break of structure. Comes back down, wicks it a second time, and then continues going higher. This is a very important thing you need to understand. Never consider a wick as a break. It isn't. A wick is simply a liquidation. When you see an aggressive wick like this that goes below a low and then closes back above the low, that is an indication of market reversal. This throws many people off. And then what happens? Many people try to start selling from these levels. The truth is that we were never bearish. This is simply just a liquidation. The same thing happens again. We break structure. People are looking to long in here, no problem with that. Then price comes back down, wicks the low, and then immediately starts reversing, and people are trying to sell in here, which doesn't make any sense because we're actually still bullish. So that's our high. This is our low. High, low, higher high, higher low, higher high. So you can see that each swing point is getting progressively higher. That is clearly indicative of bullish price action. From this low to this high, anything in there before we break the low is a range. So don't try to be trading short in this market. Does it work in this specific scenario? Yes. Will it work more times than not? Absolutely not. If you try to do this consistently, I can guarantee you that you will lose trades. Then you can see that we get a change of character. A change of character is simply the first sign of a shift from bullish to bearish. You can see that price was putting in significant highs, and then eventually at some point, price breaks a low that is responsible for putting in a new high. That's a break of structure. If we then break that low that is currently in control of the market, that's a change of character. That's our first sign that the market is getting ready to turn bearish. So at that point, that is when I would be looking for shorts. Then what you can see is that we have a low down here, price comes back up into here, and then gives us a new low. Price comes then back up again and does what? Price wicks the high, doesn't close above it, closes back inside the range. I just told you, this is a clear sign of manipulation. It's a clear sign of a market reversal. Then you can see that we do get that reversal, we do get that manipulation, and then we break structure on the sell side. This right here then becomes a break of structure, right? So this is what the market's looking like at 1 a.m. This is because the clocks have moved forward now. So 1 a.m. on the charts right now is actually 2 a.m. back then, but the charts are just different. 2 a.m. is the open of London. So if I just go turn my indicator back on, this is what price looks like as I approach my London session. And even still, just before we even get into London, when I'm doing my actual market outlook, right, which is 30 to 45 minutes before market opens, I understand that we're bearish. So my bias for the day is to go short. So as we approach the day, now I have a clear understanding of what direction I should be looking for. We were bullish. At these points, I was looking for long positions. Then we've shifted, change of character. Now we're bearish. We get a break of structure, a pullback, another break of structure. So now today, I'm clear. My directional bias is lower prices. That's the most important concept. That's what enables me to consistently be on the right side of the market. The second concept is order blocks. Now, for those of you who don't already know, or maybe for those of you who do know but don't really understand an order block, let me kind of explain it to you. This graphic right here, this is how the market actually runs. It's always moving from phases of consolidation to expansion, into consolidation, into expansion, sometimes into consolidation in these areas. Sometimes you can get a straight up reversal, straight back into a continual expansion. Now, why does the market do this? Simply put, a range often indicates fair value. That means that buyers and sellers are agreeing on price at this specific level. When you get these areas, when you get these ranges in price, that is the perfect opportunity for smart money to start loading up positions. Why? Because it's fair value. Simply put, there are many different market participants all transacting in one tight range. So sellers and buyers are both mutually agreeing that this is a fair price to get involved in this market. Now, with smart money being so large, what they need to get their orders filled is an area of consolidation, because they need slow price action that invites other participants to take the other side of their price move. They can't get involved in sells if there are no buyers, and they can't get involved in buyers if there are no sellers. So they need other market participants. So these areas of consolidation are the perfect opportunity for a buildup of a position. Then typically what happens, and this is what makes a great order block, is some kind of manipulation. If you see a range like this, and then you see an aggressive move in the opposite direction that, takes out some high or some internal high like this, that is the perfect sign of what could be becoming a perfect order block. Why? Because everyone who's building positions in this area right now is betting on one side of the market. Buyers want higher prices, sellers want lower prices. If the intention of the institutions is to push price lower, then they want buyers to step into the market. So what they can do is they can cheekily manipulate price or stop selling, right? It can work two ways. Either they can manipulate price themselves by buying, which then if we break a high or an internal high, it floods a bunch of buyers into the market. You have the breakout traders who are waiting for this level to be taken out so that they can be confirmed that it is indeed going higher. And then what they can do is they can start getting into the market, which does what? Initiates buy positions for then smart money to be able to get more of their sell positions in at the value that they want to get price into. If they just openly sell a bunch of their positions, it will move the market because there aren't enough buyers on the other side to take that bet. So they have to artificially induce it a lot of the times. The second things they can do is they can just stop accumulating orders. Now, what will happen if they stop accumulating orders? Let's say the price is at here right now. And in this entire time, institutions, or smart money, or whatever entity it may be who has the intention of taking price lower has been accumulating orders all in this price range, right? Trying to get as much of their money in the market as possible without moving price too much so they can get a better average order value. Then what will happen is they can then take orders out so they can stop putting sell orders into the market, which then what would happen? Well, now the buyers would be able to push price through this level. Why? Because there's no resistance. You see, the only thing that makes price hit a level, come back, hit a level, come back, and hit a level and come back is because there is a seller here that every time price comes into, it's just absorbing those orders. Well, if that seller steps out of the market, there is no one to absorb those orders anymore. So instead of price bouncing like it does in these ranges, it can simply just trade through. And so that's one way that they can allow momentarily buyers to induce themselves by thinking that the buy side of the market won this battle. And then what they can do is then they can actually initiate with the remainder of their position so that they can get everybody else to flock into the market. So what they do is they'll spend time accumulating, 60% of their position in this range. Then they'll allow more buyers to get into the market. They'll start accumulating as much as they can in this specific area, which is the highest price point. And then they'll initiate, an extra 30% of their overall position, which takes out all of the buy side of the market. They simply can't absorb that many orders. And then price starts aggressively going to the sell side. Well, here's what's interesting, because then what they do is they allow for the herd mentality to push price lower for them. Because the moment that they can take price past a low like this, the buyers disappear. So the buyers step out the market because they think that they've lost this battle. There are like stop losses underneath this low. And because there are stop losses underneath this low, those stop losses act as sell orders. So it's actually selling liquidity that comes into the market. And then you have the sell side breakout traders. So combine all of these things. You have all of the stop losses that when they get triggered, they're going to act as sell orders coming into the market. Then you've got the breakout traders that are waiting for this range to be broken out of on the downward side because that is their bias. So when that happens, then they're able to get their positions into the market. And the fact that a lot of the buyers who were getting involved in these areas or were thinking about getting involved in these areas now withdraw from the market. And so that they see that the sell side of the market is starting to overpower, and so they get scared and they remove their orders. They no longer want to buy at this price point. And so because they remove their orders and all of the other sell side liquidity is coming into the market, that's why you see price run to the sell side aggressive and fast. And that is what is known as an order block. When you see this range, manipulation, and initiation, right? And by the way, this entire thing that happens here is happening on lower timeframes. If you zoom in and you go up to a higher time frame, it will look like one specific candle. So if you want to look at this entire range, right, from the low to the high before the aggressive move, let's say that was a 5-minute time frame. Then you move up to the 15-minute time frame, or it was a 1 minute, and then you move up to the 50-minute time frame. It would look like 1 or 2 candles. So if we look at this area right now, this bullish move here, that does what? It buys out of this range. It buys above these equal highs and above this old London high. It buys out of that level, and then it aggressively sells off, leaving a break of structure and leaving a bunch of what? Fair value gaps, which are simply just inefficiency, meaning that there was an overload on one side of the market. Why? Because there weren't buyers that were willing to take the opposite side of this position. They had already withdrawn themselves when they started to see the aggressive momentum kicking into the market. All of this factored in is what creates an actual order block. It's understanding the logic behind it. Most traders fail, especially smart money traders, because they try to play on pattern recognition and they don't understand the deeper why behind price. Why does price do what it does? What they try to do is they just try to look at an order block or a fair value gap, and then they try to base everything off of just pattern recognition. You need to understand context. You need to understand what's really going on. And that's what I've spent the good part of these last 3 years really doing, is not just honing in my ability to read order blocks or market structure. It's truly going deeper and understanding, how does this market work? Why does this market operate like this? Why on this day did it do this, but on a different day it didn't do this? All of these little pieces are what enable you to have context, which is the other portion of what's required if you want to become a consistently profitable trader. No trader is going to get profitable just by trying to copy patterns. It's never going to happen. That's why I can put videos like these all day long on YouTube, and they are so valuable and they're full of everything that you theoretically need, and yet so many people will go away and not be able to execute them, is because they don't have the deeper understanding of why. Therefore, they're not able to see it consistently. So just kind of bear that in mind. This is literally one of the main things that we give to our clients inside of Prosperity School, is the actual context behind price. Why does price do what it does? That's what enables us to choose the right order blocks. I always get the same questions. Okay, order blocks work, but how do you choose the right order block? How do you choose the right liquidity? How do you choose the right market structure? And I'm giving you guys frameworks and principles, but it comes down just as importantly to context. Why this order block? Why this structural level? Why this liquidity pocket? Why now? Why in this session? Why in this 30-minute window? Those are the keys. So we have our bearish intention. We also now have our clear point of interest, right? We have this entire range. If I go down to a lower time frame, let's say I go down to a 1 minute, a 2 minute, or whatever, and I kind of zoom in to this area of price, what you'll see is the aggressive manipulation into this level. Bearing in mind, this entire kind of market in here is really and truly a range. We come back into the range, we manipulate the range, and then we have the aggressive sell-off. So it's this manipulation and then the sell-off, right? That's what we really want to be having our eyes on. Aligned with structure, right? Structure plus order blocks equals profit. No point having one without the other. So now I'm coming into the market and I have a framework. My framework is, for this session, I'm expecting higher prices into here and then lower prices from here. Very simple. I'm just expecting the order flow to continue. The likelihood is that we take out this low down here. It's just continual structure, right? The probability indicates that this low will get taken. And always have to understand that the market is bearish until it isn't. And when it's bullish until it isn't. And so you just have to play the probabilities. So when I'm coming into the market, I have this area of price mapped out. I have this buy side liquidity above here mapped out as well. But that's not all. Because then when price gets into this level, right, when London session opens, now I need to confirm this area. So sure, I could just place a trade like this and put my stop loss above this high and take my profit down here in this low, and it would give me a 1-to-3. And again, 1-to-3, it's not a bad risk to reward ratio, but I can go better. With one simple thing, I can increase my risk to reward and increase the likelihood of winning this trade by using lower time frame confirmation. So when I get into these levels, I can drop down to, let's say, a 1 minute time frame, and then I can wait to see how price reacts. Because now what I want to see inside of this level is an absorption and a shift of structure. So pretty much, if we come in here, you can see that at this moment in time, the buy side is technically in control. 1 minute time frame, we are looking aggressively bullish. Inside of this, we don't want to just be selling when buyers are clearly in control. I want to see the absorption in this level. So what I want to see is, as price gets into here, by the looks of things, we could just continue doing this. I don't want to be getting in the market if this is happening. So what I want to see is confirmation. I want to see price come into here, start stagnating, something like this, and then giving me a shift of a low, showing me that buyers try to win in this area. Sellers who wanted to protect this area because they still have bearish intention, they were protecting this area and they were absorbing the orders. And so when people are trying to buy, they're matching them. Buy, they're matching them. Buy, they're matching them. Until eventually the buyers wear off because they realize that they're not able to push price past this level. Then when they stop, buying, and a lot of the buyers are removed from the market, it's a lot easier for the sellers of the market to then be able to push price down. And that's what I want to get involved on after that confirmation. So what I'm simply doing is just waiting. I'm waiting for price to come into these levels. You can already see, right, the difference between these aggressive moves to when we start to approach these levels and the kind of range-bound price delivery that we're getting. This tells me that we're getting some level of absorption. Then what you can see is a shift. You can see in here that we go from high to low up to the high in here. That is a change of character. So that right there is our confirmation that we can go short. Now at this point in time, I'm looking for the same thing again. I'm pretty much, looking for the range before the sell. You can see it quite clearly. Price gets into this level, we range, and then we sell. This is the absorption. So I'm interested in getting involved in this absorption area. And so I can put my entry on this level. I can put my stops just above it. Now 1.7 pip stop loss is, these days at least, are very, very rare to come by. I would love to add a little bit of breathing room just in case price wants to run this high. I don't feel comfortable with a 1.7 pip stop loss. 3 pips, even that is very, very small stop loss. And so this is, again, the framework. Now, where would I be looking to target? I'm just looking to play the continual structure. We're bearish. We have a high to the low. We're inside of this range. I'm expecting that price will continue bearish. That is the highest probable scenario. I've got my area of interest. I've got my confirmation. And now I'm ready to go. Now, this doesn't really play out exactly how I would like it to play out. As you can see, price comes up, we don't get tagged in, then price comes to the sell side. We do have equal highs in here. That is obviously buy side liquidity, so you can leave your position on. Price again does the same thing, all right? Doesn't tag us in, and then begins selling off to the sell side. At this point, you want to be really removing this order and waiting for another chance to get in. So what you want to be doing is you want to be playing the structure levels, right? You want to be playing these pullbacks. Now, typically I would be looking at selling from this area. So I could look at putting a sell in here, but the reality is I don't see the entire flow. I don't see any fair value gaps inside of this buy to sell. And so at this point, I'm simply just waiting. Then price gives a pullback. Then we shift the lows. Now we've shifted the lows. Now I can actually see, because now we have this. We have this range in price. We have the push up into the area that I wanted to execute from, showing me that this area is respected. We have a fair value gap inside of here. We have the aggressive buy to sell, and that is where we're then able to execute our position. So you can look at taking the actual buy in here to sell, and you can put your positions in here, right? Now stops, again, 2.4 pips. For me, I would prefer a little bit of breathing room. Yeah, you know, I've doubled the stop size. I could have it lower, but that increases the likelihood that I get stopped out. So putting it down here, 4.2, it's safe, it's sensible. And then where are we looking at targeting? Pretty much, I'm just looking at taking out the swing low down here. And just a little bit past it, give me a 1 to 5 risk to reward. Now, why do I always stress about this 1 to 5 risk to reward on this specific system? It's because with a 1 to 5 risk to reward, that simply means that if I take 5 trades, I could lose 4 trades and win 1 and still be profitable. That is how powerful the risk to reward of this system is. It gives you so much room to breathe. Whereas a lot of systems that are, 1 to 2s or 1 to 1s, they require you to win so many trades that it becomes a lot more difficult to manage. So high risk to reward, when it makes sense, not forcefully, when it makes sense, allows you for the breathing room. And so then it's just a case of waiting for price to tag us in and see if we can get executed on this position. So just kind of moving into the 5-minute time frame. See, we're getting the aggressive sell-off. At this point, you may be worried and price is leaving you, and a lot of people at this point, they're trying to sell in this price leg. They're FOMOing into price because they're seeing it move aggressively and they didn't get tagged in. And so now all of a sudden their entries are all the way down here and their stop losses are still up here. And then they're going, for these types of risk rewards. And you've just completely ruined your edge. You've ruined the entirety of the system. And so many traders are doing that. And these are the small details. So this is where we're looking at getting into price. You can see price comes into our level, tags us, gives us a really nice reaction, comes back into the new order block that gets formed in here on the 5-minute time frame. Nice sell side liquidity on the sell side, and then begins to run through. Now we create perfect equal highs with the lows in here. Again, what happens? We come into here, we start reacting up in here. And so many traders, when it doesn't come into their area and price starts moving away in here, they just close out their position. Right? They just close the position. And then all of a sudden, you've got, instead of a 1 to 5 risk reward, you're getting a 1 to 3 risk reward. Maybe if you was the FOMO guy, maybe you're getting a 1 to 3.8. You map out this really good, high quality trade, but then because of your poor psychology, lack of execution, lack of discipline, and lack of processing, you've turned what was an amazing 1 to 5 trade into a 1 to 1.4R trade. And this happens so many times. I see traders do this so many times. And it's just huge red flags that they need major work with their psychology and some other very important things. But for the sake of this video, let's just stay focused on our actual technicals. So our TP was down here somewhere. And so you wait for price to come out. And then that's all you have to do. And then price seamlessly moves to your take profit level. Then when you become a more advanced trader, the more things that you start to understand and pick up, then you can actually start expanding your profit levels based on other things like higher time frame levels. You understand that there's an area of interest in here. Now between this take profit and this in here, there's nothing for price to react to. There's no reason that price would react from this level and start reversing. So what you can do is you can take off most of your position in this level, and you can leave a portion of your position to run to the logical next reaction point. Again, these are the things that as you kind of get more detailed and better at your craft and your game, you'll be able to incorporate into your trading. And if you do that, portion of your position, again, what are a lot of people doing? This happens, price starts doing this, and again, they're closing out their positions. Just allow your analysis to play out. Allow your edge to play out. Allow your read on price to play out. That is how you build confidence. So that is the first trade setup. Now, what have we done here? We've understood market structure. We've combined it with our understanding of supply and demand and lower time frame structure and supply and demand to execute this. This is literally mostly predicated off of structure and order blocks, with very important contextual understanding and psychology, of course, and risk management, but primarily structure and order blocks. That's all it really is. So if we play price out and we fast forward a few more days, what has now happened? Well, this trade has been and gone. We put in a high, lower low, lower high to lower low. This is the trade that we're able to capitalize on. Lower high up in here, lower low, and then we have a shift. Now we have a change of character from here. And so now what you can look at is, well, now we are swing low to swing high. It's a larger price range, but it still meets the same criteria. And so you still trade the same thing. And so what are a lot of traders doing? Again, a lot of traders are trying to trade this. They're getting stuck on trying to trade this internal price structure because they don't have the mechanical system to understand that we're actually bullish right now. And again, if we look, what do we have? Range, aggressive price, and then this entire thing in here. This is really just a range. And then we have the expansion. Now we're coming into New York PM session and we're bullish. Londoners give us nothing. We're bullish. Let's take our fib from the low to the swing high up in here. So here is our discount, 50% of the fib. Anything below this we can use as our order blocks. Well, now we've got to try to find our order blocks. You can see all of these order blocks that we could look at have been mitigated. Other than what? This one here, which, yeah, I mean, possible, it's not too bad, but there's no real manipulation in here. The second one, this one in here. Why is this one better? This one is better for two reasons. One, it actually takes out a low, right? If you zoom in, you will see we actually aggressively run past an old low before we get the bullish expansion. Two, it's on the 50%. And just above it, we have New York AM session lows, which is liquidity for buyers of New York session low. Same thing again, we're bullish. Coming into New York PM, what are you looking for? You're looking for, into your point of interest, a stagnation, right? And a market structure shift that confirms that this is the area. This is why it's also very important to have this. Because when you have multiple areas that you could use, you can't just take a trade on here and here and then target here. Because what if it's this order block? What if it's this order block? What are you going to do? You're going to take 3 different trades. Are you going to try to take one trade here and put your stop loss down here? What are you going to do? You need to have a mechanism. And so for me, that's why the confirmation works. I get higher risk to reward and I get more confirmation. Then it's just a waiting game. Price heads into our area like this. And at this point, what do? We go down to the 1 minute time frame. Now what do you see? Price has been aggressively bearish whilst it's coming down. And when we get into this area, we get an absorption. The sellers that have tried to push price down, they're still trying to push it down here. But now the buyers from this area are absorbing those orders until eventually the sellers stop trying to attack the level because they can't. They're not winning. And so you can still see we're in this absorption phase. We're still in this absorption phase. We have a low that gets taken out, still inside of this absorption phase. Right, still aggressive run of the lows. This is still absorption, right? Still absorbing. Same thing, right? All of this is absorption. Sellers are really trying to attack this price level and they can't. They can't get near it. And then the momentum from the sellers wears off. And then you have the shift, because our low down here up to our high, back down to our swing low, to our new high. Change of character, right? Look at the absorption. The sellers aggressively tried to take out this level. They couldn't. Buyers come out on top. That's my confirmation. Now I need an area of interest. For me here, when I have multiple different areas, I'm looking at 5 minute, 15 minute, 3 minute, to be able to identify what kind of area of demand that I'm going to use to get into my position. Because if we go to M5, we have 1 order block, we have 2 order blocks, we have 3 order blocks. Right? There's 3 different order blocks that I could use inside of this price range. But this is all just one big range. And so what I can do in this specific scenario is, again, this one is cool. I mean, it takes a little bit of liquidity. It comes into a fair value gap. This one is the cleanest. Why? Well, we actually have some liquidity to take at these lows. We have the manipulation of the low. And what we'll do, just to protect it, is we'll use the lows to cover our stops. So we'll go long position in this level. You could put it at the low here. You could even put it in here, right? Just comes down to your context and understanding. 6 pip stop in this level, stops at the lows. That's the protection. Where are we looking to target? Well, the high is all the way up here for a 9 risk reward. I like to take a portion of my position off at 5 risk reward so that I can allow, even if sometimes, because this happens as well, when you're in a position and then it reverses on you, I like to take money off the table. So that's why I want to have my first take profit. That's going to give me 5R. Second take profit, I can take it up in here. Third take profit, again, this is where it comes down to things like context. I already understand on the higher time frame, we're aggressively bullish. I already know that. Higher time frame, aggressively bullish. So we have this old high that's been waiting to be taken out as well. So I can use that as a third target. So I have 1 target, 2 targets, 3 targets to take out for this position. We'll go to the M5 to take the position, kind of speed things up. And then it's an execution game. Price comes in, always covering lows when it makes sense. It's also the difference between some people, right? Like some people want to try to use an order block and then put their stops as close as possible to get the highest risk reward. Well, sure, it might look amazing, but then what happens when you get this? Which happens a lot. So when you can logically cover what makes the most sense of the low or of the high if you're shorting, that still gives you the risk reward that makes sense. And then you can see momentum kicks in, there's your first target. Maybe your target's hit, maybe it hasn't hit. And then your target gets actually hit. That's your 5R. Here's your next target. And then up here, you've got your final target. And there it is. Structure and order blocks are the 2 most powerful concepts. Of course, there is more to trading than just structure and just order blocks. And if you're a serious trader and you want to become consistently profitable and you want my help to do so, you can check the link in the description. There's an opportunity there for you to speak to one of my team members and see whether or not you could possibly be a good fit to get mentored by myself.